Good afternoon, people. Welcome to another episode of the Everyday Trader. This is your host, Eric Hale. I'm joined by my partner and colleague, Greg Jensen. Say hello, Greg.
Good to be here. I'm sporting my Trader Oasis hat today. So
Glad to see it.
doing a little bit of
Um,
advertising for you, Eric.
Thank you. Thank you. And we're also excited to bring an extra special guest on today. We've got Jake Hanley, who's here to talk to us a little bit about Teucrium. Is the right way to say it,
Hey,
Jake?
yeah, you got it. That's right. It's
So,
Teucrium.
Teucrium. We're excited because I met Jake at Camp Code Talk, which is a really fun event. We get a lot of smart people together and talk about stuff. And Jake and I were talking. We had a great conversation, and I said, "Hey, would you like to come on to the Everyday Trader?" So the Everyday Trader is a podcast or a YouTube channel that's dedicated to trying to help retail traders. Think of your everyday regular guy, try to and gal, whatever, try to understand more about the market. So we try to decipher. We spend a lot of time talking about macro and looking at Fed policy, and we try to break it down into, listen, this is why you care about these sort of things. And ETFs in general and commodity ETFs are something that I think are interesting, and there may be some appeal. And as a minimum, certainly our audience can learn a lot more about what these things are. So we're excited to bring you on, Jake. So tell us a little bit about your background and who is Teucrium?
Yeah, thanks, Eric. No, it's a pleasure to be here. I appreciate the opportunity. My background is I'm noticing, sorry, as I look down, my computer's not plugged in. So I don't want to lose you. Let me just fix that for a second while I go
Technical
under the
issues. No problem. This is hilarious. Hey, things like this happen in real life. So
Yeah, it is real life, and I'm just noticing my computer will die. So one moment. I apologize.
No, this is actually when Eric talked to me about bringing you on, Jake, I was actually pretty excited about this myself because this is, when I first started in the financial world, I grew up on a farm.
Awesome.
And so I grew up, my dad grew wheat, we grew sugar beets, we grew potatoes. Being from Idaho, we grew potatoes a lot, like everybody does here. But
Sure.
my first exposure to the financial side of that world was watching my dad, grow a crop of wheat, harvest it, put it in the bin, and then play the futures market to try to, first of all, hedge so that they had enough money to make the operating budget work and to have a guaranteed amount of money that they would get for the crop that year. But then he'd play the futures market to try to leverage a little bit more of return out of the crop that they grew every year. And so it really, exposed me to the ups and downs of financial markets and quite honestly, sometimes the risks of exposure to the futures market. So I'm excited to learn from you as well of some of the ETFs you guys have put together to do this same type of thing.
Yeah, so thanks for sharing that, Greg, because that's really interesting. So your first exposure to the world of finance and trading was through wheat futures.
Yeah.
Wow, that's really neat. Yeah, I'm still learning about the industry, as I think all humble people are always learning, right? But my background is unique in that I went to school to study history, and I became very interested in monetary history, trying to figure out how the world works at the base level of money issuance. At one point in my career, I was on the advisor side of the desk working for Merrill Lynch, and some things happened where I ended up here at Teucrium working for an issuer. And in my position now, what I'm really charged with is helping educate folks about commodities in general. And I get to continue to do the research that I enjoy. There's a big connection, of course, between money supply, inflation, and commodities. So I really enjoy being able to work in the field that I like every day. But talking about wheat and using wheat futures to manage risk, I mean, thank goodness for the futures market. I tried to make this point on an interview yesterday that, without having the ability to offset risk, and for the farmer, yes, of course, but also for the buyer, right? We would not have the advanced the advanced economy that we have today, right? Like that trading is so important for the commodity, for the economy at large. It's a key point. So that's cool that you came up, learning through that.
So I'm really excited about some of that other stuff too. Greg and I were talking ahead of time because we want to make sure that we leave enough time at the end to talk some about your macro thoughts and
Oh,
monetary
sure.
policy and what's causing inflation and where's that going. That's really
Yeah.
exciting for us. But in terms of, so just explain really quickly what an ETF is, and then
Okay.
what's a commodity ETF?
Yeah, what's an ETF? So an ETF is an exchange traded fund, is what that stands for. ETF, exchange traded fund, and the fund holds, multiple different investments. So probably the most famous ETF in the world is SPY, SPY, probably next to the Qs. And you think of those ETFs as being stock ETFs, where they hold SPY has 500, or supposedly 500, the S&P 500 stocks in that one holding. So you get full market exposure through one exchange traded product, and that's the SPY ETF. Take that same concept and apply it to commodities. And so there are diversified commodity funds. We, for example, have a fund called TILL, ticker TILL, which is going to give you price exposure to corn, wheat, soybeans, and sugar. But we also have our single commodity ETFs, such as corn, wheat, soybeans, and sugar, right? So we break those out into single commodities. So the idea here is that you have a product that you can trade through your brokerage account that's giving you commodity future price exposure. There is a little bit of a challenge for folks to qualify to open a futures trading account. Usually the minimums are pretty substantial in order to do that. Trading futures is not as simple as trading stocks. And I don't mean that trading stocks is simple, right? But it's not as easy to open up a futures trading account and get started. So what we've done for folks is make it hopefully just as easy as trading stocks to have that exposure to commodities through a commodities ETF available through your brokerage account. And so that's the genesis of Teucrium. And I know it's a funny name, but Teucrium Trading is the name of the company. It's got a nice alliteration to it. And our founder, Sal Gilberti, grew up on an herb farm where they had Teucrium bushes. And so when he was thinking of a name, he said, Teucrium Trading. That just sounds nice.
Teucrium bushes, huh? Are they edible?
No, they're not edible, and I don't even know that they do anything. I think they're kind of nice to look at, but we have one in the office. I think we let it die.
Yeah, I'm looking at pictures of them right now. They're pretty.
Yeah,
like
yeah,
they're of the mint family, looks like.
Yeah, that's right. But I don't think you ought to eat it. So that's Teucrium Trading, and so we have 4 exchange traded funds for the single commodities, corn, and what I'm going to argue is probably the best ticker on the street. The ticker for corn is CORN.
That is a damn good ticker that you got that. There's no question what that is.
Yeah, there's no question what you're getting there. Wheat is wheat without an H, so WEAT. And we have soybeans, SOYB.
Wow.
Sugar is CANE, right? I mean,
there you go.
You gotta have the right.
That one should have been SUGA, so it would have been sugar. That probably sugar. So, you and I were talking before we scheduled this, or when we were scheduling this last week, we were talking about pros and cons, and I related the story of, my background is in nuclear, and I know a little bit about uranium, and we were telling the story about Sam Rhines, somebody else we met when we were at Camp Kotok. Sam worked for a company, and his portfolio manager said, go buy some uranium futures because he heard there's going to be new nuclear plants. And Sam tells the story that we got stuck with a contract and ended up having to take delivery of uranium, which is a really, really special situation where you have to have special, where obviously you can imagine if you're going to take physical delivery of uranium, there's all kinds of hassles. So he said, yeah, we actually ended up having to get a special warehouse and take delivery of it. If somebody is somebody gonna have to buy bushels of corn if they're trading corn ETF?
No, and if if we do, that's a big problem. No, so the way that the fund is structured is we designed it so that it could help mitigate the impacts of Contango, to use a big word. And this is going to tie right back in, Eric, to your question of taking delivery. But I think this is a really important point about futures in general, right? So futures markets, contracts have expiration dates. And so when you say take delivery, that means you've owned a contract that has expired and has reached delivery. So if you're long that contract as it expires, you're going to take delivery. And if it's uranium, you're probably going to get a knock on the door from the feds. If it's corn, you better just have a huge warehouse, right? So what we do is we own the second contract to expire, a third contract to expire, and the December following the third contract to expire. So that does two things. One, because we're in the second to expire month, we sell that before it becomes front month, right? We sell that before we're ever at risk of taking delivery. The second thing that it does is it helps mitigate against contango. And I mentioned that a second ago. Contango is a big word. It has nothing to do with dancing. And it has everything to do with the pricing structure of the futures curve. And a lot of people are probably familiar with the yield curve, right? As you go further out in maturities, you can plot dot to dot what the curve on yields looks like. Same thing with the futures curve. As you go further out the expiration date on contracts, you can plot a curve. Now, the curve looks like you have lower prices in the front, okay? And the prices gradually get higher as you go to the back of the curve. And that's a contango market. So near-term dated contracts are at a lower price, long-dated contracts are at a higher price. Okay, so if you're going to sell the near-dated contract and buy the longer-dated contract, you're selling low and buying high. Not a winning formula for a long-term strategy, right? So we diversify the benchmark, diversify the fund, so we have 3 contracts spread across the curve. So in essence, we're only rolling a third of the fund 5 times a year. So to the extent that the curve is in contango, we're not putting 100% of the portfolio at risk of realizing that contango. And so that helps mitigate that negative roll cost. But yeah, so the second, the third, and the December following means we're not at risk of taking delivery of corn.
I knew that, but I just wanted to make sure that we got that clear. Because
Yeah,
people who jump into futures trading might not realize that you're out there in a market where there's people like Greg's father that are trying to deliver corn to other people. So he's out selling contracts and hoping that he can sell it. And there's also speculators and other people out there.
Yeah.
Which brings us sort of to the question. So, I'm not asking you to provide trading advice and stay within the range of what you can.
Sure.
But does this fit into a sort of strategy that a typical retail trader might be looking at? And why would they consider buying wheat or corn or soybean or sugar?
Yeah, so that's an excellent question. For anyone who's familiar with oil, or if you're familiar with gold, grains should be on your list as well. And the simple reason is that they follow supply and demand fundamentals just like oil does, right? Gold is a little bit different because it has that money component to it. Gold being actual money. We can talk about that, but that's a different component to gold. But the idea is you have supply and you have demand, okay? And so for oil, take a step back because these numbers are pretty interesting. The corn ETF right now is at $57 million or something in it, okay? Corn prices are below $4 a bushel. We're right at around that cost of production level for corn, okay? When you look at oil getting below $40 a barrel, that's roughly a cost of production level. And, we look at some oil ETFs, famous oil ETFs, in 2014, let me make sure. Yeah, 2014, 2015. So not the time that oil went negative, okay? But prior to that, oil prices got back down below $40 a barrel. The most well-known oil ETF took in over $3 billion in flows as oil got below the cost of production. These are smart, you could call them traders, call them allocators, investors, whatever you want to call them, okay? They're realizing that the cost of oil, the price of oil is near the cost of production or below the cost of production, right? So long-term, it makes sense to put that in a portfolio, wait for the price to appreciate again. So corn below 4 is like oil below 40. Right. And so in my mind, I'm sitting here thinking we should have a major problem with position limits. I mean, $3 billion coming in the fund today. Let's go. What's going on? But I think part of the problem is people don't realize that, right? Corn is not in every headline every day. When people think of commodities, they think of oil, they think of gold, but they're not paying attention to corn. And frankly, not a lot of people know that the corn ETF exists, even though it has a fantastic ticker.
Well, we'll make sure at least a few hundred people know that.
Yeah, we appreciate that, Eric.
But we talked a little bit about the golden grain cycle. Does that apply here? Is that something you want to share, or do you want me to share? Is this the right time to talk about it?
Yeah, sure. If you have that website available, Eric,
Yeah, sure.
if yeah, you pull it up. So, right now there's three major points that I would make about grains in particular. First and foremost is the seasonality. Okay. We are headed toward the seasonal lows, which typically are like October 1 is when you get the seasonal low in soybeans. Corn, you can argue it's mid-August and it retests in October. But basically right now we are hitting the harvest lows heading into October. There's the chart. Perfect. Thanks, Eric. So that seasonal pattern is playing out at exactly the same time where corn prices are getting back at that cost of production level. So we're trading at the harvest lows, October 1, at the same time the golden grain cycle is approaching the cost of production. Now, what you're looking at on the screen here is the front month generic, spot generic price for corn futures going all the way back to 2006. Okay. And so this chart shows you that we're estimating the cost of production to be around $3.50 a bushel. It's a national average. It's our best guess, at what the national average would be. Futures price equivalent. Any farmer watching this would say, hey, my cost of production is higher than that, or it's lower than that, whatever. It's going to be all about your local cost inputs. 350 futures national equivalent cost of production. We're headed back towards that level. Now, what's really interesting is that you can see 3 times in the last 17 years, prices have doubled from the exact same range where we're trading at today, right? Going from around that 350 to over $7 per bushel. All right. So stage 1 of the golden grain cycle is right in the middle of that chart where you trade sideways for a period of time. And you're trading sideways because there's plenty of corn. Same cycle applies for soybeans and wheat, by the way. You trade sideways when there's plenty. Now there's some volatility there, and you can see, prices go from 3 to roughly 425 or 450. So there's some volatility when you're moving sideways, but stage 1 is you're moving sideways. Now something happens eventually. Typically it's a drought, which occurred in 11 and 12. You had 2 huge La Nina back-to-back La Nina years where you had drought issues and prices spiked. Now in 21, 22, interestingly enough, you had La Nina climate patterns and bad droughts. Brazil was very dry, Argentina very dry, and those are major producers. But we also had something else. We also had the war breakout in Ukraine, massive amounts of money printing and money supply growth. And so we had that inflationary flux that you see in 21 and 22. That's stage 2 with prices jump. Then you get to stage 3. Stage 3 is simply when production catches back up with demand, and it takes some time because there's only one growing season in North America, right? We only have one harvest per year. So it takes a couple of years, but eventually the production catches back up with demand and prices come back down toward that cost of production. And so we think that we're getting back to that stage 1 level. Yeah.
I was gonna say, can I add one more aspect of this natural cycle? And again, I'm gonna share, from a grower's standpoint, and still being friends with a lot of people that I grew up with that are still running farms, is there's a natural tendency on the farmer's budget decision process every year that when prices are around their cost of production, the question mark starts to go into the farmer's mind every year of, man, I can't afford to plant, this field into corn this year. I'll lose money, so I'm going to plant it into something else. Whereas when corn's at $8, they're automatically saying, oh yeah, I'm going to plant every field I have to corn, because, and then what's the resulting impact is we have overproduction, which then causes just natural supply and demand. Prices drop because there's so much corn, there's so much wheat. And so, yeah, I absolutely look at this cycle and go, yeah, I've lived that cycle. I remember that.
Yeah, you get it spot on. I mean, the term plant fence post to fence post, I saw images back in 2022 where people were planting over dirt roads, right? They said just plant as much as you possibly can. And so, it's interesting too, though, because the prices very seldom get too far below the cost of production. I think that's a key point now for allocators, certainly, who are looking at the world and wondering where's a place to park money where there's potential upside right? Where I can be surprised to the upside, but I don't necessarily have the expectation of much more downside. And I think when you see a commodity trading at or near that cost of production, that commodity, just like oil was for folks back in 14, 15, can potentially be that place to hang out. I think that's important.
Now, so the question is, when I look at this, I think, oh, the argument sounds really reasonable that we're getting down low near that production, probably not going to go much below 350 if we do. But I'm also looking at that stage one where it goes from 2014 to, you got 6 years of hanging out in stage one. How does the corn ETF hold up in that sort of environment?
So in that environment, you have two things working against you. One is the contango that we described, right? Where there's that negative roll yield, but also, the cost, the fees that are in the portfolio, which, the net expense ratio is fairly low. I think we're at 20 basis points right now for a net expense ratio on corn, but, fees are working against you. And so my answer to financial advisors that are looking at that, I say, look, the problem with diversification is there's always opportunity cost, right? If you're building a diversified portfolio, you're going to have some things that zig when other things zag. Don't know exactly when that time is going to come where prices are going to take off. By the way, again, that range of moving sideways is pretty large, $3 at the low end to $4.50 at the high end. So if you're rebalancing, there might be a way to capture some income off the top there, but really it's a diversification play here. And so, yeah, the opportunity cost is what it is there. I think for you gentlemen, what's really interesting, because you're the options expert, right?
Yeah,
So
there you
if
go.
I
That's
have
where I was
something,
already going.
yeah, if I have something in my portfolio that isn't giving me a lot of juice right now, well, what are some of the strategies that I can deploy to make that earn some money for me while I hold it in a sideways pattern? So
Let's be clear that you don't have anything to do with the options market. That's a
correct.
totally separate. I don't know if people understand this, but if you buy options on Apple, Tim Cook doesn't really care because you're not buying anything that Apple issues. He'd rather you're buying shares, and so Jake, his company, they don't issue options. There's other market makers that issue options. So there are options out there on corn, and the liquidity is not great, but for me, there's certain strategies that tend to work in a low liquidity environment, ones where you don't make a lot of adjustments. If you're doing weekly or monthly options, not very appealing. But the thing that sounds appealing to me is a long-term covered call, maybe even slightly in the money. You've got a ton of protection to the downside. You're making theta. You got some protection. Maybe you tack on an extra long call, and if you do get an explosive move up, you can use the credit from the short call to pay for the long call. And so you can be generating theta, making money in a sideways trend. And if you get an explosive move up, then you can benefit from that. So you don't want to be making a lot of adjustments.
Eric, I did the math already for you. While Jake was sitting there talking, I pulled up WEAT. And again, I'm not giving you investment advice, but ticker symbol WEAT. There's actually decent liquidity in that one. Not huge liquidity, but much better than the other ones. But yeah, January 2026 in the money covered call generates a 20% return. And WEAT said, again, doesn't have to go anywhere for you to attain that type of return. So
the only risk really in the cover, despite what Bloomberg says, not Bloomberg, I don't know if you probably heard me talk about this. Barron's wrote an article a couple of years ago about the covered call saying the risk is the stock goes higher, but that's not the risk. That's what the max profit is.
Yeah, we did an episode on that and referencing, I believe some litigation. Was it against Morgan Stanley? I want to say that Morgan Stanley settled with the client.
Yeah, that's right. That was a while ago.
I think it was called the misunderstood covered call.
Yeah, there is an episode on the misunderstood covered call. So when you hit your maximum profit is when you get assigned. So you want that short call to get assigned and try to make that. And Greg pointed out, looking at a 20% annualized return with, now you would miss out on any massive upside, but there's a way to address that. So yeah, that's pretty interesting. So Jake, I was talking about the comparison of spot to corn, and when you and I were talking before, I was able to pull that up, but I don't know. I went to I usually do that on barchart.com, and for some reason I can't pull it up on bar chart right now. I'm not sure what the deal is.
That's all right. I can share my screen and show that. And so the key thing here to remember, because I've gotten the phone call in the past where an investor is watching CNBC and CNBC is quoting corn futures, right? And so they got spot or front month corn. Did that share, guys? Can you see that chart
Yeah.
as before? Okay.
Yeah.
So front month corn futures, according to CNBC, are up 2%. Investor calls and says, "Hey, Jake, what's going on? My corn ETF's only up 1.25%. I say, "Well, I know that's because remember, we own 3 different futures contracts. We're not invested in the front month. And so we're not going to be as volatile as front month. And so what you're looking at here is the bright yellow line is your front month corn futures contract. Okay. And this is a long-term chart, 5 years going back to 2019. The white line is the corn ETF. And, past performance isn't indicative of future results. I have to say all that stuff. Okay. But you get the idea here that yellow line in 2020, front month corn futures started moving up and they moved up pretty quick. Okay. The corn ETF advanced. Corn futures are up. The corn ETF's up. It's pretty simple, right? But it just didn't go up as fast as front month corn futures did. Now, eventually, it all caught up to each other. And as we got to the peaks here in 2022, we're there. And importantly, the same investors don't call when front month contracts are trending down and the corn ETF, again, not being as volatile, is down, but not down as fast as front month. And so,
hey, how come my account's not down more? You don't get those phone calls?
Yeah. Well, what gives, man? Why are you guys? Yeah. We don't get those phone calls.
Yeah.
But so, we designed this fund very simply to give investors exposure to corn futures prices. We wanted to put it in a structure where you could hold it for a period of time. You didn't have to be a day trader, right? You can hold something like this for 6 months to a year or longer, and that Contango isn't going to eat you up, right away, right? Because it's diversified across the curve. So it is the type of ETF that you can own strategically for an intermediate term, right? It is also one that, because it goes up when corn prices go up, that you can trade, on a daily basis if you want to. You're just not going to have all that juice that you would have if we were 100% in the front month.
Let me ask you a question. So people who own USO, even in an IRA, get a rude awakening when they get a K1. Is that the same thing? Is there any special considerations from a tax standpoint with corn?
Yeah. So the other disclosure we give is it's not tax advice, right? But I've had experiences with K1s in the past. These corn, wheat, SOYB, and cane, okay, those 4 single commodity funds we're talking about, they all issue tax form K1. Now, if you own it in your IRA or qualified account, that K1, it really doesn't matter. We actually, PricewaterhouseCoopers, our tax agent, they don't even mail it to accounts that are registered in a qualified account. Okay. Some people, and I had this problem. I used to work at Merrill Lynch, and we had a client in a MLP paying, with a K1, and that MLP had unrelated business income, became a taxable event inside an IRA. I was a junior guy on the team. I had to make the phone call. Not a fun phone call to make, right?
Yeah, I guess it's MLPs that people have to worry about.
So, and so technically, because the purpose for these trusts, it's an ETF trust, is to invest in corn futures. We don't have to really concern ourselves with unrelated business income. This is what it is. And so, yeah, like I said, PricewaterhouseCoopers doesn't even mail out those K1s to those qualified accounts. If you have a non-qualified account and you have the exposure, you're going to get a K1 in the mail. Corn typically gets the K1s mailed out at or around Valentine's Day. So by the end of February, you should absolutely have all your tax forms. You can get them online on our website, Teucrium.com. And if you call the number, our main number, you get me. So you can talk to me if you have any trouble getting your tax forms.
Ooh, watch out what you ask for there, man.
Yeah, well, they can be a pain in the butt. And it's important to me that our investors have the information they need in a timely manner. So.
Well, I think it's kind of timely. Zoom in way back out beyond just commodities right now, or the soft commodities, the agricultural commodities. You mentioned gold and oil, and dude, there is some really weird stuff going on in the commodity market right now. I mean, do you have any thoughts on that in general, or maybe even more specifically, why is gold at all-time high? And oil, I saw Citibank came out yesterday and said buy oil at 60, because that's probably the floor. I don't know, but a $60 a barrel oil is just crazy for me to be thinking about the end of summer here. But I don't know if you have any thoughts on any of the other commodities beyond the agricultural ones that you follow.
Yeah, so let's we'll take oil first. I think, oil is telling you what some of the industrial metals have been telling you for a while, that global growth is not too hot. And we had a premium built into oil. I think when we were at Kotak, I was having a couple conversations with some energy folks, and we were watching headlines, waiting for Iran to drop the big one on
Right.
Israel, right?
Right.
Like
That was what happened that weekend, we thought.
Right. I mean, that was a pretty hairy time. So I don't think those risks are gone. But the premium is not in the market anymore, right? And I think oil now is having broken down through some really important technical support levels. On its way to 60, perhaps lower. I mean, I wouldn't be surprised to see oil put a 5 handle there, 50
Wow.
handle. So that's what's going on. It's the global economy is not doing great. Okay. America, the United States, we're okay. I think we're going to get a 25 basis point cut here. The futures markets, Fed funds futures are pricing in, I think, a total of 8 cuts before a cut cycle is done. To me, that's
Fed's going to cut rates in September, 25 points. You heard it here from
Jake.
Fed,
Guaranteed.
No.
I can't give guarantees.
Yeah, I know, kidding.
Put that one in your pipe and smoke it.
Well,
it's 25 basis points. That's what it is.
The real chairman of the Federal Reserve, Nick Timiraos, says it's a quarter point. So it's a quarter point.
That's all you have to do is read Nick. That's all.
Yeah, that is all you need to do. He does have 100% accurate forecasts. I'm pretty sure Nick gets a peek at the cards ahead of time. So, but you don't have to you have to live under a rock to not know, because it's coming across the board. Everybody from Goolsbee to Waller are all saying a quarter point is probably appropriate. So I think the markets will freak out if we don't get a quarter point, and they'll freak out if we get more than a quarter point. So I'm right there with you. I'm sure Greg is too.
Yeah, no, for all year I've been saying I didn't think there was going to be a rate cut at all.
Yeah, I didn't think we'd be cutting in September, because I thought the election that they might be, but it's certainly, the narrative is pretty clear. So we'll see in a couple of weeks. What about gold? Speaking of central banks, what's your thoughts on why gold is an all-time high?
Yeah,
near. I mean, it's off a little bit, but we're basically there.
Yeah, no, I understand. So those who are patient in gold, that's the prudent way to be, right? Look, we know that there's large demand from central banks. We see what's going on in the world. The geopolitical situation's not great. There's obviously concerns about debts and deficits, and whether those concerns are founded or not. I think it makes sense for sovereign nations to diversify their currency holdings. And if you're going to be overweight in your dollar reserves, okay, you're betting on the US dollar. When you see the world starting to fragment the way that it is, and let's be clear, the world is fragmenting right now, right? We are getting closer to that 1984 George Orwell, split of having 3 distinct global sectors of the world, where war is peace, freedom is slavery. I mean, this is in my study of history. I don't know if I mentioned that I studied history in college, right? That was my major. This very much looks like those warnings from the books that I read back then are trying to work their way into reality. And so that fragmentation of a rebalancing of the global world order says, yeah, let's own some gold, because we might have a different economic relationship with a different world power in the not too distant future, right? And so the United States, we're looking at issuing tariffs. The Biden administration has tariffs ready to go to be announced on China and EVs. By the way, when Canada did that, China responded right away by investigating their canola exports. Canada exports something like 50% of their canola crop to China. China's a really important market for them. Canada announces, tariffs on their EVs. China says, well, hold on a second. Maybe we don't want your canola. All right. That is a fundamental problem that could happen to the United States. The United States sends a ton of soybeans to China. We need China to buy our soybeans. China will continue to buy our soybeans because there's not enough in the world, right? We'll just be the buyer of last resort. So at what price? And I'm sharing all this because it really comes down to that idea of which country are we going to do business with? And if you're not America, you're questioning your continued ability to do business with America. We want you to do business with us, right? And I will say this till I'm blue in the face. Production is the ultimate reserve currency. If you produce the goods, you get to set the terms. It's as simple as that. So if we have food, we have oil, we have the things that the world wants, we're going to tell you, you're going to pay us dollars. And that way, there's always perpetual demand for dollars. To the extent that we don't have the goods, or to the extent that you have a leverage or leg up that you can throw out our face, such as chips, right? Semiconductors. If you have something else to raise your bargaining power, all right, now we have a two-way market and there's a give and take, which is probably good. But the ultimate point here is production is the world's reserve currency. And so the United States, as long as we can keep the goods, we'll be all right.
Well, we are truly blessed, and I mean blessed as a country with the natural resources that we have, and we take it for granted. I had a friend of mine from Japan one time, and I was traveling over there, and there was a big to-do about Japanese not buying American rice, and America makes higher quality rice, and they like our rice better, but they wouldn't buy it. And I, asked my friend why, and he said, "Well, when you control a country's food, you control the country." And I said, "Well, we're allies." He said, "Well, we 60 years ago we weren't allies." So, this was 20 or 30 years ago when we had that conversation. It just made me realize how fortunate that we are that we have the abundant resources that we do in this country, and the reserve currency, the U.S. dollar, afford us a ton of privilege. So we're pretty fortunate where we are. So I don't want to dive too deep, but you and I were able to
go as deep as you want, Eric.
No. I'm thinking back to Camp Kotok, and I had several eye-opening conversations. We had Harvey Rosenblum, who's former Dallas Fed researcher there, gave a jaw-dropping speech and made a few comments that certainly sort of opened my eyes and changed my perspective. And then did you stick around for Sunday night?
No, unfortunately, I had to get home Sunday night.
Yeah. So Sunday night, we have this sort of open sort of conversation on the back porch, and you did get to see Byron Callen, the
yes
guy. He didn't get to talk very much. Did you get to spend much time talking to him one-on-one?
I did get some time, and actually I've been listening to a podcast that he's on regularly because he was very sharp.
Yeah, I need to get that. I'll check it out. So thanks for reminding me of that.
Yep.
But, we had so he's an expert in military, and let's just say that you and I in this conversation haven't talked about our military, but we print our own money, and we've got an army and a navy that going with the natural resources. Thinking of Warren Buffett, it's been a bad idea to bet against the United States, and I don't think now's the time to start. So I do think this is the right place, and we've got everything in place. And like it or not, we've got a administrative and a power structure that doesn't want to see things change. So I think it's more of the same going forward.
Yeah. I would just comment on that production being the ultimate reserve currency, absent the use of force. Right. So if we're all going to be gentlemen and get along, we're going to trade with one another, and we're not going to force each other's hand. All right. But if push comes to shove, yeah, baby, what backs the US dollar? It's our military might, right? And might makes right. I do get worried about a potential hubris creeping in there at some point. And, if I take a stand back and look at the world and how these conflicts are all shaping up, there's multiple fronts that are at play now, right? And so stretching resources too thin could be a real issue. by the way, I think, defense spending is probably going up.
You think?
Yeah, because we have some issue with our munitions. We need to restock our munition reserves.
Because we left a few billions of dollars worth in Afghanistan.
Yeah, that was brilliant, huh? Geez, Louise.
Those all turned into purchase orders. They got sold again.
Yeah. So there's a business case there, I suppose. But yeah, that's just the point. I mean, there's two things. One, if we're going to be gentlemen and have free trade, not in the term of how it's used today, I truly mean freely trading in a voluntary economic system with global partners, then production is your ultimate reserve currency. But if need be, there will be demand for US dollars because we'll make the world pay taxes in US dollars.
Yeah. So one of the other topics, or another event that Greg and I went to, the reserve currency of the US dollar was there, and Paul Ryan was speaking, and it was and Federal Reserve people. Is pretty interesting. That's used to be a topic. It seemed 2 years ago, people were really concerned that it's not on the radar now. I don't think so. Greg, did you have any macroeconomic? Jake's Twitter handle is what is your Twitter? It's macro.
That's a good question. Macroview_Jake.
Macroview_Jake. If you want to follow, I'll put that in the notes so people can get a link to it. So that means you care more about Macroview, or you obviously have some interest. We talked a little bit about monetary policy and some big picture stuff, but any thoughts on soft, hard, no landing? Any when's the recession? Any macro thoughts on where we are?
Is that for me or Greg?
Well, I was going to ask Greg to ask you that question, but I went ahead and asked it for him. Unless Greg, you want to say it differently? Sorry, Greg.
No, that's fine. Let's do that one. I've got another question for you in a minute, but I want to hear your
all right.
views
So,
first.
I put something out. I tweeted last night. I don't know if this is true. Maybe you guys can help me with this, right? But is there such a thing as a soft landing or a hard landing? Like, isn't the business cycle such that every business cycle ends in a recession and then the new one comes out of the recession? And if I think about a plane landing, a recession means you go through the runway. Like, that's negative growth. You no longer have any lift under your wings, right? So as long as you have some lift under your wings, your economy is growing. So there's no such thing as landing. Like, you're either growing or you're not.
Right.
And so, I understand people, maybe they're saying, well, the soft landing means we have a recession, but maybe it's not so bad. I'm like, no, a recession is a recession. And by the way, it's okay. That is the nature of the economic cycle, right? And so, are we going to have a soft landing or a hard landing? Look, we're going to have a recession. I have no idea when it's going to come, but it is going to come because it's just the nature of the business cycle. My biggest fear is that when the recession comes, that we're a bunch of wimps in this country, excuse me, but that we print money to give people money as soon as that recession happens, instead of allowing the pain to work through so that you come out stronger on the other side, which, is probably not going to happen. And so the risk is you have a recession and we print more money instead of, just going through it.
Well, isn't that kind of what we're doing right now with the Fed? I would say capitulating to cutting rates. I mean, if earnings are growing,
Yep.
and the economy is doing fine, and unemployment is okay. Yes, we're slowing, but I guess I still have a hard time justifying the need to cut rates, other than it feels like the Fed's capitulating to the market, whining and wanting one. Do you agree, or?
No, I don't agree. And here's the reason. The Fed cutting rates is okay given the fact that inflation has come back down, right? So if I can get 5% on my cash savings account and inflation is only 2% or 2.5%, like, that's too easy. It shouldn't be that easy to just mint money in a savings account. What we want as a society is for people to deploy those savings and investments to try to do better and grow the economy. Okay, so interest rates, by the way, are they're not as effective of a tool as actually injecting capital into the system, right? When
Agreed.
Everybody got a check in the mail during COVID.
Agreed.
So, the way the money growth happens in regular times is somebody goes to the bank because they have an idea for a new business, right? They see an economic need for a new business or to grow their business. And so they borrow money from the bank. When the bank lends that money, the bank is actually creating money that doesn't exist. Not everybody knows that. Like, it's new money that gets created, right? So if I deposit $1,000 at the bank can lend $10,000, right? They literally, the commercial bank makes money out of thin air, okay? So that is how you get new money creation through the banking system, but it's to meet a proprietary need. There's actually a business case for that loan being made, right? And so that is okay. So if interest rates come down to spur that demand for people to take loans and take risks to meet a perceived business need, that's okay. That's healthy. If it gets all the way down to the point where interest rates are zero, that's a whole different thing. Or where we are printing money and giving money to consumers, direct deposits to bank accounts again, that's where the real problem is. Moving rates down, to the quote terminal rate, whatever that might be, 3.5%, 4%. I think that's okay. It's not necessarily capitulation. I think it's encouraging people to, try to help grow the economy again.
Take risk.
Well, do we need to stimulate the economy right now? I mean,
that's a good question. I don't know that you need to stimulate the economy. There are signs that the labor force isn't as strong as well, we know what the revisions, right? What the former headline numbers are, or I've seen some chatter on Twitter. I think Mike Green and Danielle DiMartino Booth are commenting on the fact that you have all these gig workers not being accurately reflected in the job numbers. And so if someone is picking up a gig job that otherwise would prefer to have full-time employment or better employment opportunities somewhere else, is that a sign of the economy doing well or not? Again, this is all getting into the weeds, into the details. To keep it simple, the way I explain it to my mother is, Ma, you're getting 5.5% in your checking, in your money market account. Inflation's only 2.5%. Rates have room to come down.
Yeah, for sure. There's the other issue, the productivity, which is off the charts, and people are having a hard time explaining that. And one of the guys from Strategas a while back presented a hypothetical that maybe the undocumented workers that we have in this country can explain some of that. And I'm not taking a political side on this either way. I happen to be very pro immigration as long as we're legal immigration. I think the reason this country's great is immigration, but you're measuring productivity output. So that's output versus input. And if you're not tracking the input because people are either under the table or not documented otherwise, you can see it. We keep talking. In fact, I heard it, I guess this morning, I was listening on the radio and they were talking about, productivities across the country is very high. And I've tried to talk to some of our friends that we see at some of these events, some chief economists, and they scratch, I don't understand your point, Eric. So, well, wait a minute, let's look at the definition of productivity. It's hours worked. And let's say that you've got 3 million people who aren't reporting hours. Oh, okay, I see your point. So it's the bottom number is smaller than it should be, then productivity goes up. So I don't know. It's an interesting thing to think about. I don't know if it's a good thing or a bad thing. It's just interesting. So what happens with CPI? Okay, go on.
I was just gonna say, we need data on that, right? That's just one of the biggest problems with illegal immigration is you don't have the data. And you have folks also, right? So productivity is going up. I love that point. That makes a lot of sense to me. But we also know there's a lot of people who are coming across the border who need services, right? And with it could be that the productivity gains outweigh the service drain. Right. So, but we just don't know because we don't have a clear insight into those numbers. And so it's what a mess. I mean, we have so much technology in this country. Why can't we just have people at the border just scanning retinas or taking fingerprints right away, put you in the system, and then boom, you're good to go. Like,
Yeah, from a data standpoint, just to purely so that we
just
have
data.
Yeah, just so we know. So, be helpful to try and drive without having all your gauges working on your vehicle, or fly this plane without all the data. So just from a data standpoint, it would make sense if we had all that.
That's a really good point though on productivity.
Yeah. Eric, I got a question that is kind of a little bit different topic, but I'd love to hear your opinion on it, Jake. I mean, you mentioned China specifically and soybeans specifically. I know we're in a call it a proxy conflict with Russia. We're in a proxy conflict with Iran right now, in the two different wars that are the two different hot wars that are being fought in the world. I know the biggest concern of a lot of the people I've talked about is the potential coming conflict with China, and whether that actually becomes hopefully not a hot conflict with China, because that could be one that could be very ugly. But there definitely is an economic war being fought with China right now. And I'm sure tonight in the debate, we're going to hear a lot of conversations about tariffs and what they mean. And you've heard former President Trump talk a lot about the tariffs he plans on imposing. And we know it'll impact soybeans. Are there any other commodities that you feel are either at risk in a conflict with China that are maybe already in play, or others that are maybe potential opportunities if, I know there's a lot of those tariff fears priced in if those don't come to fruition?
Yeah, no, that's a good question. Other than soybeans, nothing comes to mind in the markets that I follow the closest. So we could probably have a conversation for a few minutes and think of some other items in commodities, but personally, I don't like tariffs, right?
Yeah.
I saw Kyle Bass was on CNBC earlier today, and he made a great point. He said, look, it is one of the policy tools that you have. And, if you need to use it, I think it was Kyle Bass. I don't want to misattribute this. It could have been the other guest, but it is a policy tool that you have, and you can use it to negotiate. And if former President Trump is anything, I think his track record is he's a pretty effective negotiator. And so, my hope is that it doesn't materialize to where we see what we saw prior in 2018, 2019. China walked away from the United States soybean market, and we were left with a bunch of soybeans. And that was a problem. Now we have some things happening. I don't want to get too far away from your question now, but some things happening in the United States where we're trying to build some additional demand for soybeans in particular, and that's as it relates to biofuel policies. Okay, and so we're waiting for the Treasury Department to issue some guidance on how those credits work, but that could be helpful for adding some additional demand and for beans and bean oil in particular for biofuels. But absent of that, tariffs have a way of, one, you can make prices more expensive, right? Imports are going to be more expensive. But two, if we're not exporting because of a tit for tat trade war, then our local prices are going down, right? And so now as an American consumer, I'm paying more for my imports and I'm getting paid less on my product that I'm serving. So it's not a great situation. I don't get excited to think about tariffs, but I think we're getting tariffs either way, because to your point, we're dealing with an economic adversary that we're trying to avoid a hot conflict with. I think we're trying to avoid a hot war with. So,
yeah, one of the comments that I heard when Biden took over, the policy on China is essentially Trump's policy, so we didn't really change much there.
right.
We'll see. There's a lot of talk, and I think people need to step back and look at the facts. But I want to be respectful of your time. I really enjoyed this conversation, and I look forward to many more conversations with you in the future. Are you going to come down to that New York thing?
Yeah, that's in December, right? I got to get that on the calendar. I want to be there. No, thank you both. A lot of fun. You gave me a lot of airtime. I hope I didn't.
Oh, we love it. I did want to wrap up with a couple of things. Just where can retail traders go if they want to learn a little bit more about commodities and Teucrium? And then the other is that, are there any resources that you would recommend following to try and stay, ahead or on top of the agricultural commodity, the grain market?
Yeah, absolutely. So for us, it's teucrium.com, TEUCRIUM. Here, I'll put my head this way. You can see the TEUCRIUM.com. Our newsletter, it's right there. You can subscribe. I write most of that content. One of our traders helps us with daily commentaries that are available typically on X.
Okay.
We post some on social media, on LinkedIn as well, but we're mostly on X. As far as the grain markets in particular go, a great follow there is a guy at Standard Grain, Joe Vaklovic, and he has a YouTube channel. He's working really hard. He's a really good guy. And so I would recommend Joe Vaklovic. And then every day you have AgriTalk Radio. They're on AM radio, or you can get them where you get your podcasts. And that's a Pro Farmer publication. So it's Chip Fleury and Davis Michelson. Those guys are awesome.
What was that again? The last one was
AgriTalk.
AgriTalk.
Yeah. And I learned more listening to AgriTalk than anything else, right? It's an important thing. So those are the recommendations.
Well,
Eric, you'll like this. I just went to follow Joe Vaklovic on Twitter, and one of the recommendations was Chip Fleury then to follow him as well. And his hashtags are Cyclone Nation, #Cubs.
Oh, I gotta love him.
He's a Cubby. He's a
Iowa and a
Cubby.
Cub fan, so can't go wrong there.
There you go.
Yeah, that's awesome. Appreciate that.
No,
Yeah, I
appreciate
told
you
I rode-
guys.
I-
Thank you.
When I met you and found out you had corn, I told you I rode my bike across Iowa was the first thing I ever mentioned yet. So there's a lot of corn. Most corn in the nation, by the way. Well,
There's
per
a lot
capita.
of corn. I remember going to Iowa for the first time and landing, just leaving the airport, and they talk about planting corn up to the highway.
Yeah, right
Like
to the
there's
highway.
like right to the edge of the highway, all over the place. It was beautiful. It's
And great people in Iowa. So, all right, Jake, I really appreciate you making time to be here, and I hope that we get to see you again real soon.
yeah, no, thank you both again. Appreciate it. Pleasure meeting you.
Thanks, Jake. Appreciate it.
Take care. Bye-bye.
All right, so I stopped the recording.
Oh, good.
You
All
wanna-
right. So I don't have to log